Hello, my name is Manny Kagan. I am a mortgage professional and I started mortgage business in the mortgage business in 1983. In 1985, together with my wife Alpha, we started Pacific Bay Financial, which is the oldest mortgage brokerage in the Bay Area. And I have a very special guest. I actually introduced you to him a few months ago. I don't even remember what was the subject then.
Buy down.
Buy down. Oh, that's right. It was one of the first buy downs. Correct. Yeah.
Yeah, it
Since
was a buy down.
I had conversation about buy down today with a client, as a matter of fact, potential client.
Yeah.
So that's still it became hot product, but it cooled off a little bit.
It still applies with the interest rate actually fluctuating,
Yes.
trending back
Yeah.
higher.
Yeah.
It's still applicable, definitely.
But Sheldon Smith is he's which one? Nures of
PacRes.
PacRes. Before he was Nures, now it's PacRes. I'm always mixed up with the names, and I mentioned I don't care what the name of the company as long as I have right person to deal with.
You're forgiven.
Yes, thank you. Today we're going to be talking about very interesting subject, which I was introduced relatively recently, but it's not new product because in older times they were doing 105% loans also. But those loans which are available today, they're 100% financing. Even not 100%, it's 105 or whatever closing costs are, if we can include it.
102 to 103.
Yeah. Basically, it's one of those incredible products, and it's designed for people who have good income, because you still need to qualify, but have no money. So I just happen to have two clients in this category. I had a couple came to me a year ago, and they said they wanted to buy property. And when I ran their credit report, I saw they have a lot of debts.
Yeah.
And they were not, well, would be suicidal to have debts and another debt. So I suggested to them to pay it off. And first to pay, get rid of all the debts. And they did.
Yeah.
They called me a year later, and now we're getting them, I'm introducing them to real estate agent, and now they're looking for a property around $1 million, 900 to $1 million, where they'll be able to get 100% financing.
Definitely.
So how does it work?
Yeah. So one of the biggest myths out there still to this day is that a borrower needs 20% down payment to get a purchase. And that is so far from the truth, because even before down payment assistance, etc., a regular Fannie or Freddie or FHA loan, a borrower could put 3% or 3.5%. So technically, if you had your own funds of 3% or 3.5%, then you had the ability to purchase. But California, the state of California now have a down payment assistance product that in the case where that borrower does not have that 3.5%, then they could get a down payment assistance from CalHFA towards the down payment. And another advantage that it allows, if that same borrower doesn't have closing costs, they could get up to 2 to 3% to assist with the closing costs.
Interesting.
So, yeah.
So basically, as I mentioned before, you do not need to, you better to have some money, but
if you don't, then you could still get into a home.
Because those clients, they still have, I think, 16 to 18,000, which I said you need to some moving costs.
Exactly. Because if you're going to get into a home, the probability of something happening is high. So you definitely still need to have some kind of reserves.
Yes.
Because you're not sure what could happen.
Yeah.
So, but it's giving you the opportunity to say, okay, if you only have a limited amount of cash, you don't need to feel down as if you cannot purchase.
Okay.
Because it's giving you the option of saying you could get the assistance for the down payment. And if you're light in closing costs, you could also finance. And
so how many loans a borrower is getting? 3?
So technically you could do, it's up to 3 liens. So you're getting a first mortgage.
Which is conventional FHA loan or?
Both. So if the borrower wanted to do a conventional loan, the option is there.
Conventional it's not, there's a conventional and there's FHA.
Correct.
So conventional, how much down payment they have to put? 3%?
Well, they're going to do a 97% first, and they're going to get
on conventional.
Correct.
97%, and if it's FHA, then it's 96.5%.
Yes.
So it's basically 3.5% versus 3%.
Correct.
So what's the difference between those two programs?
Well, technically, the difference is FHA, you have an upfront and an annual MI.
Mortgage insurance.
Correct. So you're going to see where you're going to tag in a 1.75% upfront MI into the loan.
Okay. In other words, let me explain you and what's the difference. Because if you are getting a conventional loan and you're putting 3% down,
Yeah.
you basically, and then you're getting other money as well. But then you have to finance mortgage insurance.
In the loan amount.
No, on conventional, do you still have more in the loan amount or
No, no, no.
conventional? That's exactly the difference.
So that's the difference.
Yeah, so difference is if you have conventional loan, the mortgage insurance is paid separately.
Correct.
If you have FHA, it's built into the loan amount. However, in this example, there is a practically no difference because in one case, you have to come up with extra 5% down, 0.5%. So 3.5% versus 3%. So it's a simple calculation and just what's the difference in underwriting guidance?
Well, it's not like FHA allow higher ratios.
I see.
Like on the FHA, you could go up to 55% ratios with
Okay.
a lower FICO.
Yes.
So there's FICO requirements, there's ZTI requirements. On the
DTI, it's debt to income. It's qualifying interest,
Yeah.
qualifying income.
Yeah. On the conventional, the max back-end ratio allows is 50%. And of course, it needs a higher credit score.
I see.
So pretty much what you would have to evaluate to see client A, client B, to see exactly what bucket they fits in.
Yes.
Because honestly, yes, payment comes in, but it gives you the flexibility.
Okay. How about the interest rate? There is a difference between interest rate one program versus another.
Yeah, it's about a quarter difference.
So FHA is lower in a quarter.
Yes.
Okay.
Yeah.
So basically, there are two programs, and both of them serve the same purpose or similar purpose.
Yeah.
And it's our job to find out which one best suits to the client because it's just simple numbers.
Yeah.
Okay.
And here's a huge advantage. That down payment assistance, 3.5% or 3%, it's a 1% simple interest rate. But you don't make any payments on that second mortgage until you either refinance or you sell the property. So even though you have a down payment assistance second, you're not making any payments on that loan until you sell or you refi. And if you opted for the third lien, which is towards the closing costs, that is a 0% interest that you don't make any payments until the same thing, you either sell or refinance. So technically, you're only making a payment on the first mortgage until any kind of
so you owe the money. It's not that that's forgivable because before there was different program.
Correct.
But it didn't last for a long time.
Yeah.
But so this program, you still owe the money, but you will have to pay it back sometimes in the future. And it might be future very close if two things might happen. Let's say you buy it now. And a year, 2 years from now, interest rates will come down and value will go up.
Yes.
Because then you'll be able to refinance. It's
It's
again, you can take another FHA loan, but this time without this additional baggage which you have.
Yeah.
And so there's always options sometimes in the future.
Yeah.
But for now, anyone who wants to own property and has income to make payments based on conventional or FHA loan, you can do it.
Yeah. And Cal Haffa, it's not like typical home ready or home possible.
It's different program which
Yeah.
available and within
Yeah. Where it's looking for 80% of the median income limit. Like in regions like Alameda County, Santa Clara, the income limit goes up as high as say 220,000. So this is not geared for borrowers who only make minimal income. It also is geared for borrowers who make pretty good income, but they're in a position like Manny said, maybe they've actually used their funds to pay off debts, or maybe it's a situation where they make good money, they pay high rents. So based on that, they're not able to have good savings.
Yes.
So this is giving you an opportunity to say, okay, you know what, I want to own, you don't have a lot of savings, you could do the loan for 0% down.
Yes. How long it takes, since there's more than one mortgage, how long it takes to get approval? Is it a simultaneous process or it's...
Yeah, honestly, I've closed a few of these in about 21 days.
Oh, wow.
Yeah, because what you're submitting one loan to us, the lender, and we send a copy package to CalHFA,
Mhm.
their turn time right now is about 72 hours.
Mhm.
So as long as you as the loan officer move quickly with your condition, then you have the ability to close these loans in 21 to 25 days. It's not like the old days where you as a broker had to submit to CalHFA. You
Yes.
go through us as the lender.
Perfect.
Yeah.
So, which means that practically anyone can buy a property today. Anyone.
Yeah.
Of course, you have to have income. If you do not have income, we have other programs which we'll have the conversation separately.
Yeah.
But I think that it's a such important subject. When I mentioned this program to some of my real estate agents friends, they were excited, and therefore I think that what we're going to do, I think you'll be agreeing to this. We're going to have in-house seminar where I invite some real estate agents to come to join us and learn more. Because yes, this is introduction, but there's so much to learn and so much to do.
Yeah.
I want to thank you. My name is Manny Kagan, and I promise to help you. Thank you.